Hello everyone, this is Crystal with Slick Trade, and in this presentation I'm going to go over the pure price action presentation number 5, ascending and descending channel patterns. Now in my last presentation I went over ascending and descending triangle patterns, so if you haven't seen that yet, please go back to that and make sure you do all these in order, okay? Before we get started, we must start with a disclaimer. Feel free to pause the video and read through the entire disclaimer. However, when trading any financial asset, there's a possibility that you may sustain a partial or total loss of your investment funds. As a result, it is advised you should never invest with or trade upon money which you cannot afford to lose through this manner of trading. Trading involves a real risk of loss, and past performance does not ensure future results. So let's get started. Ascending and descending channel patterns. These patterns produce an approximate 73% win rate. The channel pattern usually occurs when the market is trending and acts as a delayed continuation pattern. An ascending channel pattern is defined by a bullish trend followed by lower highs and lower lows staying within a channel. Okay? Now a channel is two parallel trend lines. Okay. A descending triangle pattern is defined by a bearish trend followed by higher lows and higher highs staying within a channel. Ascending channel pattern. Okay. This pattern is complete when price breaks above the upper trend line and is considered successful when price moves from the outer edge and produces a distance of the initial move that started the channel. Okay, so in this example here, these purple lines here are a channel. They're two parallel trend lines. Okay, as you can see, we have lower highs, okay, and lower lows right here. You can see that really easily with that zigzag indicator. That's why I like to keep that on my charts. And when we break this upper trend line, okay, the top of the channel, and we move a distance, okay, of this width or more, there's a successful ascending channel trade, I guess. I don't know how else you really want to word that. Okay, but that's considered a successful move. Okay. Obviously, when it breaks that upper part, since you have the lower highs, lower lows with an ascending channel, you break up, you'd be entering a long. Okay. And the opposite for a descending channel. Okay. The descending channel pattern is complete when price breaks the lower trend line and is considered successful when price moves from the outer edge and produces a distance of the initial move that started the channel. Okay, so in this example we have higher highs. I know we have one that's a little bit shorter there, but overall, okay, if you look at here, 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 we have higher highs and we have higher lows. Okay. And when we break this lower channel, you obviously enter a short position. And as you can see, it moved much further. Okay, it just continued its downtrend from this point. We did experience some consolidation right in here, but you wouldn't have actually come up to a previous stop loss yet. Okay, so depending how you put in your pending orders and if you trail stop, things like that, you could really gain a decent amount of pips from a lot of these moves. Pending orders. When you recognize an ascending or descending channel pattern, you either A, enter at market price once that breakout occurs, or B, set a pending order. The pending order you would want to set would be just above the upper trend line for an ascending channel pattern, or just below the lower trend line for a descending channel pattern. In the example over here to the right, you see an ascending channel pattern. The upper trend line right here is the breakout area, and the pending order would be set just above that for a long position. This example here, okay? Here we identify, okay? We identify the ascending channel. Here is our pending orders, okay? Trail stopping and risk to reward. After you've decided whether you'll be entering at market price or setting pending orders, you must have a trading plan in place for take profit levels and solid risk management. In the example to the right, you see an ascending channel pattern. Okay, the same one we just had in the last example. The lines represent the TP or take profit levels for multiple positions. They are 1 to 1, 2 to 1, 3 to 1, and a fourth position of 3 to 1, all risk to reward with a trail stop. Okay, so here's where we broke. Okay, we broke out. You could have entered at this point. You could have entered at this point. So as you can see, you have hours to get into this. This is an hourly chart. On the daily chart, you have days to get into these a lot of the time, okay? So that's kind of nice about this pattern, okay? Not always, but many times you do. You'll see that consolidation point, and then you'll see breakout, okay? So obviously, this is our entry. Down here would be our stop loss. You can also set the stop loss at the previous candle low, okay, for a long position, or previous candle high for a short position. I personally like to set it at previous support and resistance, okay. Here we have our 1 to 1, okay, first take profit. Obviously that was hit very quickly. We experienced more consolidation at this point, however, did not hit a stop loss. Here's our 2 to 1, here's our 3 to 1, and then your fourth position would also have that 3 to 1, but you'd be trail stopping it. So as you can see, it continues up over here. Okay. In my next lesson, I'll be covering double top and double bottom patterns. So I will see you guys then.